Well, hello, beautiful people. This is Jessica Jones with Rebel Women Wealth, coming in for a quick discussion about the difference between a CD and a MYGA, or a multi-year guaranteed annuity. Okay, I get a lot of questions about this, especially for people in retirement or preparing for retirement, if they want somewhere safe to stick their money, to offset what they have in the market, or if they're just more conservative or they need it in the near term, like in 3 years or something like that, and they don't want the volatility of the market with that piece of their portfolio. So the difference is basically, so a CD, you can get that through your advisor or just at the bank. That's the most common way to do it. And you can do, shorter terms, or 1 year, 3 year, 5 year, 6 months. Just depends on what the rates are at the particular bank that is offering it. So basically, if we're talking about non-retirement money, so let's just say cash at the bank, if you put it into a CD, you are going to get a 1099 at the end of the year for your interest earned on that CD. So whether it's a 6-month CD or a 1-year CD or a 3-year CD, it doesn't matter. At the end of that year, for your taxes, you will get a 1099 for the interest earned on that CD. Okay, so you are going to be expected to pay taxes on that every year. Okay. With a MYGA, it is a MYGA, multi-year guaranteed annuity. So MYGA is going to be more than 1 year. Okay. Now you can get 1 year guaranteed annuity too, but then it would just be over after that 1 year. A multi-year guaranteed annuity is going to be 2 years, 3 years, 5 years, whatever. And it'll be a fixed rate for that whole term. So let's say it's a 3-year MYGA, paying 5%, let's say. You're going to get 5% for all 3 of those years, okay? It doesn't renew after that first year and readjust the interest. If it's guaranteed, it's a contractual guarantee to you. It's a contract between you and the insurance company, because that's who offers annuities. So you would get that contractual agreement for, let's say in that example, all 3 years. And you do not have to get a 1099 at the end of every year to pay taxes on that interest earned, because it's tax deferred. So the interest earned will just stay in that annuity and continue to compound and grow for you. Whereas with a CD, after that, let's say we're comparing it to the 1-year term. After that 1-year term, then you are at the mercy of whatever the rates are at that time when the CD comes due. So let's say you earned 5% on that 1 year CD, and then it came due. You got a 1099 for that interest earned to pay for on your taxes. And then whatever the renewal rate is at that time, that's what you will be offered. So let's say you wanted to do another 1 year CD with the bank, but now the rates have gone down and now they're 3.5. Okay. So then that next year you would only earn that 3.5. So that's the difference between the two accounts. If we're just talking non-qualified or non-retirement money, that's how that works. And that's how they're different. So it just really depends on if you need the money, how soon you need the money, or if you'd rather have that guarantee, if you think rates will be going down and you don't need it, for 3 years or 5 years, if you're planning on a purchase like a home or something like that, you just want to keep it safe in the interim. It's a really good way to earn a good interest rate still, because interest rates are still pretty good with those products. But also make sure it's safe if it's for a more near term or you want to be more conservative with your money. These are great retirement planning tools. They're not for everybody. It just depends on what your goals are. So if you need any help with this, just let me know. You got this, babe. Bye.